Attendees are in listen-only mode.
Alrighty, good morning everyone. We're going to start in about a minute or two's time. So yeah, grab your tea, grab your coffee. We're probably going to go for maybe just sort of 20 to 30 minutes. If you do have any questions, there is a little question box. Please, fill them in, and we'll field them at the end. It's always good to get some interaction, and we want to talk about what you guys want to hear about. So any questions you have along the way or anything you want clarified, please send us through a question. Alrighty, there it is, 10 o'clock. It's time to get started. So thank you everyone for attending this webinar for Private Mortgages Australia. I'm Tim Hart. I'm one of the directors, and just wanted to talk to you a little bit about private lending and sort of how it works and when to use it, and sometimes when not to use it as well. As I was saying before, if you have any questions, please use the little questions box. We love to get feedback and answer any questions you guys have and what you want to know, and ultimately how you can help your clients get a result at the end of the day. So what I'll do, we'll jump straight into it. We've got the first thing I want to go through is our products. So these are the three products that we offer. The first thing you'll notice is that it's business finance. So we only do non-coded loans. So what I suppose we can't do is a loan for a mum and dad who want to buy their own home, or want to go on holiday, or whatever the case might be. If it's something for personal use, we can't do it. Whereas if it's something for business purpose, so if there's a corporate borrower, so a company that's borrowing the money, and if they need it for trading stock, or it might be a developer that needs some funding to complete a project, or whatever the case may be, that's what we specialise in. It has to be a business loan. So we have three products. First mortgages, you'll notice we have interest rates between 1 and 2.5% PCM, which is per calendar month. So that gives you a bit of an idea. We specialise in very much short-term funding, and that's what private lending is all about. It's about short-term. It's not designed to be a 30-year loan or anything like that. That's more what the big traditional banks are there to do. Our first mortgages, we do anything from 50,000 up to 5 million. Our second mortgages, we have the rates are slightly more expensive because it is a little bit more risky, and we do anything up to 1 million. And we've also got really fast short-term caveat loans that we do between 3 and 5% per month, and you'll see the term on those is a little shorter as well. So usually only something between 2 to 6 months, and we'll do anything up to about $500,000 on that. So they're the three products that we offer, and sort of those time frames you can see as well. The next thing I really want to talk about is loan to value ratio. It's probably one of the more common questions we get asked is, I understand you do these loans, I've got a client that needs some money, how much can they get? And the way we do it, we break it into postcode categories. So we've got category 1 to 4, and these are based off the Genworth financial postcode categories. So if you're not familiar with those, basically your category 1 is most properties. So anything that's within a major CBD, like a Melbourne, Sydney, Brisbane, that sort of thing. Anything within, say, 40 to 50 Ks of a major CBD, that's typically all category 1. So your major centres. When you get out a little bit further into your major regional centres, that's when you're looking at category 2, so your big regional towns. And then you've got category 3 is probably your more regional but smaller towns. And then the furthest one is category 4, more commonly known as absolute whoop whoop. So something that's in the middle of nowhere. Usually it's some farming or rural in nature. And as you can imagine, because of that and the illiquid nature of the security in those places, we lend a lot less as a percentage. Now, one thing you will also notice here, we've got in the far left column, we've got maximum. Now, with private lending, it's all about being flexible. So for us, it's, we hate sort of the banks, the big banks box is what we call it, that you have to fit in the box or forget it, you don't get the loan, see you later. whereas us, it's all about being flexible, and so we've actually set the maximums there. So for residential, as much as we say, category 1 will only do to a maximum of 75, we do actually have discretion to go up to 80 depending on the circumstances. So obviously it has to make commercial sense for us to do it, and usually what it comes down to is how strong is the exit strategy or the repayment strategy of the client. Okay, so if maybe they've sold one of their own properties and it's an unconditional contract of sale, that's a pretty good exit strategy. Okay, so in those circumstances we can go up to higher LVRs. So it's the name of the game. It's all about being flexible and trying to work out a solution that's going to work for the client, but also for us as well. All right, let's get into fees and charges, because this is one of the other more prominent questions we get asked, because as you would have seen with the interest rates, short-term lending is quite expensive, especially when you compare it to the other banks. However, it has a lot of things that we do that a lot of other lenders won't do. Now, what we've got in terms of fees and charges, the first one we've got is an assessment fee. So whenever we get an application in, or one of our one-page quick app forms, what we'll provide back to the referrer or the client directly is an indicative letter of offer. And we'll do some initial assessment, and we'll say, look, here's the interest rate, here's all the costs, and to proceed you need to pay an assessment fee. Now normally it's about $550 to $770. It's only $1,100 really if you're looking into the multi-million-dollar sort of loans. And really this just covers our costs to do all the title searches and actually look into the loan once it's been approved. So that's at the upfront. The only other, I suppose, cost we have is one, if we require a valuation, it's always done at cost. Most of the time we'll instruct the valuer and the client can just pay the valuer directly. Okay, so there's no margin, there's nothing we make on that. Whatever it costs is what it costs you or your client. And the other thing we do is we release the valuation to your client once the loan is actually settled, okay, because they paid for it, it's theirs, we're happy to provide it. So we're not like a lot of banks who just won't give you the valuation even though you paid for it. We're happy to provide that. The other fee we've got is an approval fee. So this is once the loan's fully approved and the client says, yes, I'm happy to proceed, then they'll be liable for the approval fee. Now what we do, we set a minimum approval fee. So less than $100,000, it's $3,000 plus GST, and then as it goes up, it gets, as a percentage, it gets lower and lower. Now what we allow our referrers to do is that you can add your commission on top of these minimum approval fees. So, or you can mandate directly. On our website, privatemortgagesaustralia.com.au, we actually have a sample mandate you can use if you don't have one yourself, but it just makes it nice and simple that you as the referrer can make whatever you want out of the transaction. Obviously within reason. It's still got to be a win-win for you and the client. But it just means that you can sort of set it, because it might be a really tough loan, so you might charge a little bit more, or if it's a really easy loan, you don't charge as much. It's completely up to you. So it just gives our referrers that flexibility to sort of command how much they'll make from the actual transaction. The only other fee that we charge is a legal admin fee. Usually it's usually around $4,400, depending on the complexity of the transaction, and that's to get all the paperwork drawn up. Now this little sort of flow chart I've put together is just sort of shows you our process of understanding short-term lending. So the first thing you'll do is you'll submit an application form, or you can submit our one-page quick app form. We'll do an initial assessment on it, and what we provide back is an indicative letter of offer that'll give the client the indicative interest rate and also how much the assessment fee will be. From there, there's no cost to the client, and once they accept the indicative letter of offer and pay the assessment fee, that's when we then commence the bulk of our due diligence. So we'll do as much as we can in the initial assessment without incurring costs, and then once the due diligence phase kicks in, that's when we do all our title searches and bankruptcy checks and the like. Once we've finalised that, that's when we'll produce the letter of offer for the client. And the biggest thing I want to stress here is that let's say we produce the letter of offer and we hand it to the client. If they decide not to proceed, that's it. There's no other costs. There's no charging clauses. There's nothing else that's going to happen. Once they sign the letter of offer, only then are they liable to pay the approval fee, and it'll come out at settlement once the loan settles. So that's sort of our process. It's usually quite a quick process, depending on the type of security that they're offering and the loan that they're after. What I want to go through now is just a couple of quick examples so you can get to see what we do and perhaps how we do things a little bit differently from a lot of other lenders. We had a scenario, this is a loan we did earlier this year. We had a scenario where there was a director of a company and he needed to get some cash back from a director's loan that he made to his company and also to purchase some trading stock. So his company, he'd obviously lent his own company a couple of $100,000 to allow them, the company to get started. Pretty common thing, especially in smaller businesses. So he needed to get that money out, so he needed some cash out, and then the rest of the money was to purchase some trading stock to help the business keep going. Now, one thing that we did, the client actually provided us with an existing valuation that he did 3 months prior. We have a very flexible valuation policy. So for us, if you can provide us a valuation that's less than 6 months old, that's something we can use. Okay, so it doesn't have to be something that we instruct and that's done, when we're doing the loan. So he provided us a valuation at $1.85 million for a residential property in New South Wales. He already had a first mortgage on the property of 1.143, and so what we did is we gave him a new loan of $244,500 done as a second mortgage. So he had one mortgage with the bank and a second mortgage with us. The total loan to value ratio, or the LVR, was 75%, so at the maximum that we would go to. The approval fee for this one was 3.3%, and 1.1% of that went to the referrer. So we got 2.2 and the referrer got 1.1. The term of the loan was 3 months, and we also give 6 months worth of extensions as well. So any one of our loans always comes with extensions, because we always know that, especially in short-term lending, things don't always go according to plan. And in particularly with this one, the strategy was, or the exit strategy was, for them to refinance. So basically to refinance that first mortgage, to upstamp it to a higher loan amount to pay us out. Now, as you can imagine, out there in bank land, things just take forever, which is why we have the extensions in there. So this client, they went for 3 months. At the end of the 3 months, they needed to extend because the bank was delayed. So they extended for 1 month, and then the refinance came through and they paid us out. So that was how we sort of structured that deal. Now, what I want to move into is to look at how to look at a short-term loan and how to really look at the true cost of it. Now, a lot of people look at the interest rate, and a lot of the people in the marketplace are very fixated on interest rate. And for us, it's especially when you're comparing other people in the marketplace, you need to look at the total cost of the loan, not the interest rate. So for this second mortgage we charged 1.75% per calendar month. So the total interest that we charged for the 3 months of the loan up front was $12,836. Our approval fee was $8,068, of which $2,689 went to our referrer, and we had a legal admin fee of $4,400. So all up, the total cost of this loan to the client was just over $25,000. Once you break it down like that, it's a very easy business decision for the client to make. I need to get $244,000. Is it worth $25,000 in cost for this loan for the 3 months? It makes it very simple. We have a lot of people who, especially clients, they're usually getting some finance from us to go and make some money. So they might be completing a development or getting some trading stock to go and sell that stock on. So it makes it quite easy. If they get this money, they're going to go and use it, and they're going to make, say, $100,000. And if it's costing them $25,000 and they're making $100,000, hey, it's a pretty easy decision to make. Where some people get a little bit hung up on the interest rate is they sort of look and say, you're charging 1.75, someone else might be charging 1.65%, but they might have an approval fee of $10,000 and a legal admin fee of $10,000. I mean, we've seen horrendous things of approval fees of $20,000. We saw one the other day of $50,000. And it's almost, when you start looking at things like that, the interest rate starts becoming irrelevant. So for us, that's how I look at when I'm borrowing short term. I look at the total cost of it, because that's the best way and the sort of the all-encompassing way to look at it. To go through a few other examples of the type of funding we do, so quite a big one is completion finance. A lot of banks hate doing completion finance. One, because it's halfway through a project and it's a bit messy. Two, it's usually for short term. Someone only needs the money for a couple of months, and banks are more there for longer terms. So for us, we have a lot of these situations where a developer, they run out of money and they urgently need $250,000 to complete the project, and they've already got the pre-sales, for instance. They're going to settle in a couple of months. They just need a little bit of extra cash because something's gone wrong, something's happened. So the valuation, when the building is complete, might be $1.5 million. They've already got a first mortgage of $750,000, so we might come in and give them a second mortgage for $250,000. You can see there, interest rate might be 3% per month for 3 months. This is just an example, but to give you a bit of a feel for what we can do. Another one we see quite a lot of is ATO debts. So someone where the ATO is not providing payment plans anymore. So they're only, they want all their money, or they're gonna bankrupt you. So they might come in, we'll give them $100,000 to clear out the ATO, and then they can go and refinance down the track when they've got a bit more time. So it's really, in that scenario, it's sort of like a bridging finance to help them in the short term. And this is another one we see a lot of, where a business has the opportunity, has come up where they can buy some stock at a discount. So it might be buying some stock overseas, or buying bulk, or maybe one of their competitors is going out of business. Whatever the case may be, they need some funding urgently because they know if they can buy this machinery at an absolute discount, they can go and sell it or use it and make an absolute massive profit. But the thing is that they can't wait for a traditional bank to take 4, 6, 8 weeks and all the little boxes and criteria they want checked. So this scenario might be they own $1 million property, they just want a $400,000 first mortgage, and that might just be at 1% per month. So really quite cheap, and they just need it for 6 months. This is on our, this sort of goes through all the different types of things that we specialise in. It's not an exhaustive list, but gives you a bit of an idea. The main one that we have is urgent funding. So someone who needs funding now and they can't wait for the banks. Another big one is asset lending. So people who can't show serviceability. For us, we don't really care about serviceability because it's more done on an asset lend. So the loan might go for 3 months. We will prepay the loan for 3 months, so they don't need to make any payments, and they just pay us one big lump sum at the end of the 3 months. So when it would be a sale of an asset, refinance, whatever the case may be, they get the money from day one and they pay a big lump sum a couple of months down the track. ATO debts we've spoken about. We do a little bit of refinancing existing caveat loans. So if you've ever seen some of the caveat loans out there in the marketplace, when they go into default, the interest rates can get very, very high. I think we saw one the other day, it was 15% per month, and the client just needed to get that urgently refinanced out, so they had a bit more time to go and get a cheaper finance at the bank. The other one we'll do is valuation not contract. If you've ever seen one of our previous webinars, we talk about a deal we did out in country Victoria where we actually lent 102% of the purchase price, and that was because we lent him 70% of valuation. Obviously he picked the property up for an absolute screamer of a price, but we're happy to lend against valuation, the higher of contract or valuation. Another one we see people paying out business partners, or the other one we get is urgent business opportunities, so they need some funding really quickly. as we've spoken about, we do stuff with developers, whether it be just completion finance or a full construction facility. The other one we will look at is credit impaired. As I said, we're more asset lenders, so we don't really mind about sort of the serviceability or the credit of the client. As long as they're not bankrupt, we're fine. So it's if for instance the client, their exit strategy or repayment strategy though is a refinance, that's when the credit might become an issue. We just want to know that we're setting the client up for success, not for failure. Okay, so if they're trying to refinance, we're going to say, okay, let's make sure we can actually get them refinanced at the end of the day, because that's what we want. We want a happy customer that's going to come back again when they need some urgent funding. So what I want to go through is just our process of what we go through. So, and this can help you qualify deals when someone gives you a call, and you can see what we go through. So the first one on the first filter, we call it is it non-coded? Okay, so at the very start I said we only do business lending. So if someone says, hey, I want 50 grand to buy, a new sports car or something, then we can't do it. Okay, so it has to be for business purposes, and ideally the best way to do that is to have a corporate borrower or a company borrowing the funds. The client has to be accepting of at least 1% per month interest rates. Okay, because that's the cheapest we have. The cheapest loan we do is 1% per month. So if the client's not willing to pay that, then it's not going to work. The other check we do is postcode and LVR. So we want to make sure that the amount they're looking to borrow based on what the postcode of the security property is in line with what we do. So if it's in a category 1 location in the middle of Melbourne and they're after a 70% LVR, great, not a problem. But if they're trying to get a 75% LVR and it's in the middle of whoop whoop, then it's not going to work. Okay, so it's just very quickly we want to knock off each loan straight away to see if it's going to work or not. Sometimes we prefer to give referrers a quick no rather than a really, really long drawn out no, because we want to be able to just, so you can move on to the client so they can move on and do something else, or we can look at a different scenario, or we can look at what we can give them and how much could we give them based on that postcode. Another one is very important, is how much the referrer wants to make. Okay, so we want to find out, you as the referrer coming in, how much do you want to make from the transaction? The other one is exit strategy, which we've spoken about, is very, very important for these short-term loans, and serviceability is not required. Okay, so it's all about how are they going to pay that big lump sum back. The next one is, why can't the client get bank finance? And this is absolutely critical, because if the client can get bank finance and they can wait for the bank to take the ice age that they take to get loans done, then they should go and get bank finance. Okay, so we won't lend money to someone that can get bank finance because they can go and get it cheaper elsewhere. Okay, so the only people that should be coming to us is if they need the funding urgently and can't, for whatever reason, get the funding from a bank. Okay, so they won't look at valuation or the time frame, or they don't like the person's credit, or there's a million different reasons, but we need to find out what that is, because it's going to come out in the due diligence anyway, and we just need to make sure that that's going to work for both parties. And the final one is, when does the client actually need to settle? Okay, because if someone comes to us and says, hey, I need the money and I need it this afternoon, great, it's not going to work. Let's actually make sure we're working to a goal that's going to work for both us and the client. Okay, so we need to know when they need to settle, so that way we're all on the same page and we're working towards that deadline to make it work. Now, a few things I want to talk about here is sort of the borrower beware, or even referrer beware, and some of the other things that other private lenders do that you just need to be wary of. Now, none of the things I'm going to describe are illegal. No one's doing anything illegal out there in the marketplace, but some of the things that we just feel that they're not quite right. We're all about clean loans and to get better results. Okay, whereas some of these things we class them as dirty loans, and it's something that we don't really like in the marketplace. The first one is from rates. Okay, where a lender might say, oh, we've got rates from 1% per month, but where there's no upper limit as to how much they'll charge. So the client might be going in saying, oh, 1% per month, oh, that's not too bad. And then by the time the actual offer comes back and the client's all, they've signed their life away, the rate might come back at 5% a month, okay? Because you never know where it's going to come back in from. So just be very careful of the from rates. The other big one is big upfront fees before the final offer. So they'll get, as I mentioned before, we've seen one where we had a client had to pay $18,000 upfront before they even had the offer. And there's things like that. It's just, there shouldn't be so much big fees up front before the final offer. You can, I don't mind any lender in the marketplace. You can charge whatever you want, provided you do it before the client is committed, before they sign the final letter of offer. So that's just something to be aware of, these big fees. As I said, for us, we charge just a one-off fee of an assessment fee, usually about $550 to $770, and that's it. Nothing else that will be charged until they see the full final letter of offer and they're happy with it. The other one that I see a lot of is these 24-hour loans. There is very, very few people in the marketplace that can do loans in 24 hours. This is used more as a gimmick or a way to get you into the system, because they know once you're in that you can wait another 24 hours and then another 24 hours, because they know you don't want to go and start again with another lender. So if someone is claiming that they can do loans in 24 hours, I would ask them what percentage of their loans settle in 24 hours, because very quickly it turns into 2 days, 3 days, 4 days, a week, 2 weeks, and there's no recourse you have on them for these 24-hour loans. So just be careful if you do see that in the marketing as well. The other one we see a lot of is very expensive valuations done for forced sale. So not only do they do the valuation for forced sale purposes, so i.e. They want a very, very, very low price, but they also make a margin or a profit on the valuation. So this is something we see a bit of as well. And of course, the valuation comes back really, really low, and then usually the deal doesn't work, and sometimes they've then got cancellation fees they need to pay. So we'll see a lot of the time someone, the other lender might have a letter of offer or even an indicative letter of offer that has cancellation fees on it. So if they don't proceed or the valuation doesn't stack up or for whatever happens, then they're going to charge you a big fee for it, even though they didn't settle the loan. What they'll then do is put a caveat and a personal property security register charge against the client and basically hold their property to ransom until they get paid their fee. For us, that's something that we don't do. We'll never charge a cancellation fee on an indicative letter of offer. The only time we ever have a cancellation fee is if a client has signed a formal letter of offer and said, yes, we'd like the funding, and then they then pull out or the loan doesn't proceed. So that's, for us, as I was saying before, is we're all about cleaner loans and better results. So the way we do that is low upfront assessment fees, no charging clauses in the indicative letter of offer, and no cancellation fees either. The valuations we do at cost, and we also is done at a reasonable value. Okay, so we're doing it for mortgage purposes, for market value purposes, not a forced sale. The other thing is we also release the valuation to the client. We have capped interest rate ranges, so you know exactly if you're getting a first mortgage from us, it's going to be between 1 and 2.5%. Okay, it's not going to suddenly come back at 5% a month or something. The other one is we rebate any unused interest on extension payments. So if we have a client who's got a 3-month loan and then they extend for a month because something got delayed, then if they settle halfway through that month, we'll rebate that interest for the unused portion of the extension payment. Okay, so so they're only paying interest for the period they're actually using the loan. Very simple and nice and fair. The other thing we have is custom built software, which we've spent a ridiculous amount of money on, look, it is all worth it because it allows us to then process deals a lot faster. And for us, short-term lending, it's all about speed. It's all about how quickly can you get a solution and the money to the client. So that's our commitment and why we've spent a lot of money building that software, so that we can be one of the fastest people in the industry at getting loans done. The other thing we're very, very proud of is we have a high level of repeat customers. So we've had people that come back and get loans with us again and again and again because they've had a good experience, because we've looked after them, because we've got transparent lending processes. And that's something that we have, and that differentiates us from a lot of the other short-term lenders in the marketplace who have one client, and that client never wants to see them ever again because they had a horrible experience. So that for us is sort of a feedback from the clients. If we see we're getting repeat customers, we know we're doing the right thing. And for us, it's all about a win-win approach to lending. It has to be a win for the borrower as well as us, as well as for the referrer, because that's, we know it's and we're here for the long term. We want to be here for the long term, and we want to grow the business, and a lot of that comes from word of mouth and people having good experiences with us. Now, the other thing we do for our referrers, and this is something new, we've only just recently brought in this financial year, is referral rewards. So in addition to obviously our generous sort of referral structure we have, where we pay referral fees, we've got some key referral rewards in here. So if you've sent us $1 million worth of loans, we'll give you a $250 Maya card, Dan Murphy's or Flight Centre. Now, as much as we've got those three there, if you don't shop at Maya, you don't drink alcohol, and you don't go on holidays, what are you doing? But seriously, we can provide you a gift card for whatever you want. So it doesn't have to be those three, but we're just trying to get a bit of a cut of different places you want to spend some money. And then it goes up and up from there, all the way up to $10 million. Now, if you gave us a $10 million loan, for instance, you would actually get all the subsequent rewards. So you'd get the 250 plus the 500 plus the 1,000 plus the 2,500. So it's just another way for us to say thank you for sending us some business, and it's very much aimed at people who are referring a lot of business to us. Once you hit $10 million, you then become a lifetime member of the PMA Platinum Playground, we call it. And you'll receive a $500 gift card every single year, provided you keep up a minimum loan volume of $1 million. Okay, so just we want to keep rewarding those that are working with us and helping their clients with short-term lending. So guys, that's it. I said I did want to keep it within that sort of half an hour. I have gone 1 minute over. I do apologise for that. What I'm going to do now, we've just got a couple of questions that I want to go through. If you do have any questions, please send them through. We've got one here. Hi Tim, is the max LVR 70% on development based on GRV or cost to complete? So for us, what we look at in terms of LVR is the GRV, so the gross realisation value. So what's the thing going to be worth once all the work has been complete? I hope that answers your question there. The other one is the assessment fee taken off the application fee, or is this fee in addition? So we don't have an application fee. The only fee we charge is an assessment fee. It's not taken off anything. That's just our cost of doing the searches and the loan. The only other fee we have is that approval fee. So it doesn't come off the approval fee. The approval fee is separate, and that's just something that will get charged once the loan actually settles. So the only sort of fee that they'll typically pay up front is that assessment fee, and if we need evaluation, that they'll pay for that as well, but that will be it. Can we please get a copy of your presentation emailed to us, Tristan? Yes, not a problem. The other thing we'll also do is we'll send you out, everyone who attended will get a certificate for your CPD points. The professional development points. So we'll send that out, and happy to provide a copy of the presentation. Now, if you do have any questions or in particular specific scenarios that you want to run past us, please contact our National Credit Manager, Peter Cuss-Kelly, and he'll be able to answer them for you. The other thing, please look at our website, privatemortgagesaustralia.com.au. We have actually just made a massive upgrade to the site, and if you go to the referrers section, there's heaps of cool stuff in there. So there's, obviously before, there's a mandate in there you can use if you want. We've got our product fact sheet. We've also got a quick app form, which I've mentioned a few times, which is it's just a one-pager, and we just get the real high-level detail of the deal, so we can really quickly come back. So you don't have to fill in a 3, 4, 5-page application form up front. It could just be a nice quick one-pager. We can come back and say, yep, we can do that loan, or no, we can't, or whatever the case may be. So guys, look, I'm going to leave it there. If you have any specific questions, please send them through. I hope you got a lot out of this morning. Thanks very much.